Folks, howdy, what's up? So today is my second video when it comes to investing. There we go. So what are we going to do today? We are going to see how to understand financial numbers. We always see a lot of financial numbers being thrown around without knowing what they mean, but they are supposed to mean something. But what do they mean? We hear traders and then investors talk about, hey, what's the PE ratio, bro? They talk about what's the payout ratio? What's the price to book value ratio? What are all those ratios? Don't mean shit if you don't understand what they mean. They are very important things when you want to figure out the value of a company or a stock. So today we are going to take all of these very simple concepts that have very heavy and fancy names and break it down for you. So right now I will not go right into the concepts and the topics right away. The last thing I want to do is to make another boring video about finances and financial concepts. I will start with what we already know in our lives, in our daily lives. So let's say I am a person, or we consider any person, person A. What do they have in their lives? They have income. They might have debt. What else do they have? They might have savings. And they have a phone, laptop, furniture in the house that they can sell for cash. So it's kind of their assets that they can sell if they want to have more cash. And I will be looking into just personal finances and try to relate them with what all of these concepts mean when it comes to big businesses and big companies. Now let's see how we can relate these day-to-day things into investing concepts. First, we have earnings. We have earnings or income. Companies have earnings or income, so that is very straightforward. Then we have debt. It's the same thing. As individuals or a business, we might have debt. And then let's say you have a credit card and it gives you 1 or 2% cash back. This is a cashback program that you are allowed by your credit card. You might also have like other cards that give you points or cashback. These are like just free money just for having that card or having that credit card. Stocks have a very similar thing. It is called dividends. If you own a stock just for the sake of owning, they will give you somewhere from 1 to 10% dividend. Usually when the dividends are super high, like 7, 8, 9, 10, 12%, I start being skeptical. Like, do they have the cash to pay these kind of dividends? It's like, I take it with a grain of salt. Usually a good range of dividends could be anywhere from 3 to 5, sometimes even 7 when the stock is beaten down. And then let's talk about savings. We try to have savings in our account. Well, if you're responsible enough, and responsible businesses do the same thing. They try to have savings in their account, which is free and clear after paying all of their bills. And this savings, when it comes to businesses, is called free cash flow. So the cash that they have after paying off all their bills and all their business operations. And remember, I talked about assets. Like, I have my laptop, I have my guitar, I have my phone, I have furnitures in the house. I can sell any of them to have cash. So these are my assets. What are the assets called for a company? When a company have a lot of assets so that they can run their business and they can sell a little bit of them to have more cash. These assets are called their book value. So the value of all of their assets are called accumulatively their book value. And one of the ways that you can know if the business is running by responsible people is when you see their levels of debt and their levels of free cash flow. So for example, if I have $10,000 of debt and I have only $100 of savings in my account, clearly I'm not a responsible person. And when you see the same thing for a business, you know that they are not responsible businesses. They do not have responsible people behind them that are running them. What is a sign of a responsible management of cash and debt? How I see it, if the long-term debt can be covered by 3 years of free cash flow, then I think that the business is in good hands and they have the cash flow, they have a good management to cover their expenses and also the long-term debt. Then comes the dividends. A lot of companies pay very good dividends and a lot of people invest in them just so that they have these cashbacks all of their life. They are called dividend investors. But we know that dividends are not for sure. There are a lot of companies that cut dividends unexpectedly out of the blue. And they do that because they have money troubles. Maybe they took some irresponsible action. Maybe they're victims of a situation that they did not anticipate. It doesn't matter. They're in trouble. And after they cut their dividends, the stock price plummets. And we do not want this to happen to us. If we see a dividend, we want to make sure that the company has enough earnings and enough savings, like free cash flow, to cover their dividends and the business expense and the debt. Now, to determine that, what will we look at? We will be looking at the payout ratio. You might ask, what is the payout ratio? The payout ratio is the percentage of the earning that is taken as dividends. Anywhere from 50 to 70% is a safe payout ratio. That means the dividends are very safely covered. But when it comes to 80% and around that range is still acceptable. A lot of big companies, they generate huge chunks of cash and they do not know what to do with it. They have no other place that they can deploy the money more effectively. So they give out most of the money in cash, like in dividends. So 80% can be still acceptable, but we still have to check how much debt they have and how much cash reserves they have. For anything over 80, you should be careful before you invest when you see the payout ratio of anything over 80. That means they are running very tight. If any unexpected event hits the company, they might be in trouble. So when it is above 80, I would say be very careful. Just one exception though. Real Estate Investment Trusts Fund, the REITs, they have the obligation to pay out about 90% of their reserves. So whenever you see REITs and REIT stocks and funds, you will see the payout ratio of 90%, maybe even 100%. On those cases, the rule of 80% payout ratio wouldn't really count. You will look into other things to find out their true value. We will not be going into that. That is for another video for another time. Thank you so much for sticking around. We have come pretty far. If you consider that we didn't know anything about investing before we came into this video, we have known about the earnings, the debt, the cashbacks, which are dividends, then the savings, which are the free cash flows, the assets, which we call the book value. Then we understood about the payout ratio and how we can look into the payout ratio to see if the dividends are safe long term so you can sleep in peace. We also learned how to look into debts and the free cash so we can understand and know that the business is safe from anything coming its way, any critical situation. So they have the cash if they have a road bump, and they have secure cash so that they can pay off all of their debt. After we have done all of these, we have a pretty good fundamental idea of what the business looks like and what the health of the business is. There is one more thing I'd like to talk about before we go to the next section. This is called the PE ratio, and it is a very simple concept. First, we take the price of the stock and then we divide it by the earnings of the last 52 weeks, so the last 1 year. And this is called price to earnings ratio, in short, PE ratio. So now, why is the PE ratio important and what does it tell us? We know we get the value just by dividing price by earnings, but what does it signify? As investors, it tells us the exact amount of money we need to invest to get $1 back as earnings. And we also have the forward PE ratio. It is essentially the exact same thing. We take the current price and then we divide it by the earnings, but not of the previous year. The earnings that is expected for the next year. So the expected earnings of next year. So it would be the price divided by expected earnings for the next year. And this will give us the forward PE ratio. And this gives us an idea whether the company will have the same income or a higher earnings or a lower earnings. So where the earnings are going to go in next year compared to this year. Whenever we see a PE ratio of, let's say, 10 of a stock, and then we look into the forward PE ratio and it tells us 8 or something lower than 10, this is a very good sign. It shows that the earnings are expected to go up. Thank you so much for staying with me throughout the whole video. Before we finish the video, I would like to recap on everything that we went through in the video. First, we went through the earnings and debt that we have. This is the same for an individual or a company. When it comes to debt, we look into long-term debt. And then we also looked into savings, the savings that we do in cash. This for a company is called free cash flow, the cash they have after paying all their expenses. And then we have cashbacks, which are called dividends, and companies have assets, which are called book value. And then to determine whether they have a responsible amount of debt, how can we determine that? We can determine that if the debt is equal to or under 3 years of its free cash flow, that it can pay its long-term debt by 3 years of its savings, then we can safely determine that the debt was responsible. The debt levels is responsible. And how can we determine that the dividends are safe, that when we get into the stock, the dividends won't be cut and the share prices will plummet? To determine whether the dividends are safe, we go through the payout ratio. The payout ratio means the percentage of earnings that the company gives away as dividends. 50 to 70% is considered safe. And when the ratio goes above 80, approaching to 90 or around that area, you can start to get very, very careful. And at the end, we saw the PE ratio, which means the amount of money that you're investing to get $1 of earnings back. I hope you enjoyed this very short video. I did my best to keep it very light, very easy, and very entertaining. If you have any suggestions and if you want to give me a feedback, please feel free to do so in the comment section and smash the like button. Thank you. See you soon.